Guys, welcome to my channel. In today's video we will learn about two concepts. First concept is of economic value added, right? And second one is of market value added. Over here we are going to learn about meaning with the help of the illustration, and at last we are going to learn about advantages and disadvantages of both these concepts. So let's begin with first concept is of economic value added. So this measures the company's performance, or we can say economic profitability of the firm is being measured. That is value created in excess of required rate of return, right? So first is the that you need to understand the required rate of return. What is this required rate of return for investors, say for both debenture holders and your shareholders, right? So say I am a company, what will be the cost if I issue the debentures? The cost that the company will incur will be in terms of interest, right? Because the company is supposed to pay the interest to the debenture holders. So this is the cost for the debenture holders, and similarly for the shareholders, what will be the cost to the firm? That will be in terms of dividend, right? So we can say that EVA is profit earned by the firms less cost of capital, right? So this is the formula also. We are going to see this. Further, we can see that value is created when the return on firm's economic capital employed is greater than that of the cost, right? Cost of capital. Whenever the capital employed is more than that of the cost of capital, we say the value is being created by the firm. Clear till here? Alright. Further, we can see that the formula is given to us, that is EVA is equal to net operating profit after tax minus cost of capital. Okay, we have already discussed what was the cost of capital to debenture holders and to shareholders, right? This is the cost. Then we have is the capital employed, right? If this is positive, then value is being created by the firm. Let's understand this with the help of an example. I've taken an example of ABC Limited. Over here, net operating profit after tax is given to you, that is $10,000. Along with that, assets are given to us, that is $40,000, and liabilities are given to us $15,000. And cost of capital is 7.5%. So what was the formula for computing EVA? EVA is equal to net operating profit after tax minus cost of capital into investments. So net operating profit after tax is given to us, that is $10,000, minus cost of capital is also given to us, that is 7.5%. But investment is not given to us. Capital employed is not given to us, right? How can we compute the capital? If you remember the accounting equation, assets is equal to liability plus capital. Remember, this is the accounting equation. If I put the values over here, 40,000 assets is equal to, how much is the liabilities? 15,000. I can compute capital, that is 25,000, right? I simply put the value over here, 25,000. Now we have net operating profit, that is 10,000 minus cost of capital 7.5% into capital, that is 25,000. This comes out to be 1,875. And if I deduct this amount from the net operating profit after tax, this comes out to be $8,125. So this is positive, right? Hence, I can say that ABC Limited is creating value, right? So if you want to make a comparison of, say, RST R is one firm, second is S, and last is T. And if you compute EVA of these three firms, so whichever firm is creating more value, you can go for that. Alright, next concept is for market value added. This is simply whatever the firm has created value since its foundation, right? So I can simply say that the difference between current market value of the firm and initial market value that was invested. We can also say that how much a firm has accumulated over the period of time, right? And the formula for the same is market value of the shares minus book value of shareholders' equity. We are going to understand this with the help of an example. So this is the present value and this is the initial value, right? The difference between the two gives us the market value. I have taken one of the examples of XYZ Limited. Over here it says that value of shareholders equity is $0.75 million. Okay, then we have is shares in terms of preferred shares and common shares. We have 0.1 million common shares and 5,000 preferred shares. Further, we have the market value of both the shares. For common share is 12.5 per share, okay, and 100 per share is for the preferred shares. First of all, we are going to compute the market value of, say, common shares. Market value of common shares. How much common shares we have is 0.1 million into how much? What is the, for common shares it is 12.5. So this comes out to be 1.25 million, right? I hope this is clear to you. And then similarly we are going to compute it for the preferred shares. We have 5,000 preferred shares into the market value, that is 100. This comes out to be 0.5 million. Okay, then further the total market value of both common and preferred share will be 1.75 million, right? And out of this 1.75 million, I am going to deduct this. That was initial value, equity value. This comes out to be, if I deduct this comes out to be 1 million, right? This comes out to be 1 million. This is how we compute the market value added of the firm. I hope this is clear to you guys. If not, then please comment in the comment section. I will address to your problem. Okay, at last we have the advantages. First is the comparability. So if I'm going to compute EVA for A, B and C companies, this makes the accounts or the statements more comparable. Okay, then it is forward looking. How is it forward looking? EVA and MVA, it tries to maximize the value of the firm and focuses on increasing the profitability. Then focuses on value creation. How the value is being created? By focusing to increase the market value of the shares and increasing the profitability. Okay, boost the survival chances of the firm. When the firm focuses more on the value creation and increasing the profitability, ultimately the survival chances of the firm increases. Okay, next is makes companies more attractive to the potential shareholders or the potential investors. How? Because whenever the firm has positive or it is creating more value addition, then the company becomes more attractive. Last we have is alignment with the shareholders' interest. Shareholders are always interested in our long-term wealth creation, right? So with these EVA and MVA, it tries to align with the shareholders' interest and tries to maximize its value. Okay, at last we have the disadvantages. Disadvantages first is market volatility. That means market fluctuates a lot and these terms do not take into consideration, say, change in the interest rates, inflation. So this is one of the disadvantages or drawbacks. Then complexity. Obviously computation is very difficult, okay. When it comes to the huge computation of the firm's financial statement, it becomes very cumbersome process. Then it is biased towards large companies. How is it biased towards large companies? Because whenever you open up the financial statements, you can always say that of the large companies, market value is always more, isn't it? So that is why this is more biased towards the large companies. Last is a lack of consideration for the timings. How can we say that? It takes into account the investment made at one point of time and not at the various interval of time. Okay, so that is the one of the disadvantages. So that is it for today, guys. I hope you've enjoyed and learned something. If yes, then subscribe to my channel and like my video. Thank you and have a nice day.